Hello! Today we're going to be doing the journal entries related to the disposal, sale, or exchange of plant assets. So let's get right into the problem. We are told that Ellison Enterprises purchased equipment for $75,000 on January 1st, 2009. The equipment is estimated to last 10 years with no salvage value and is being depreciated using the straight line method. Assume that the equipment was disposed of on December 31st, 2015. We are to prepare the journal entries to record the disposal of the equipment under the following independent assumptions. So before we get into each of the independent assumptions down here, let's talk about a few different important accounts. First, the equipment account. In each of these situations, we're going to be getting rid of our equipment, either discarding it or selling it or exchanging it for new equipment. And therefore, we have to close the equipment account out on our books. So it might be helpful to know what the balance of the equipment account is. Well, we know that equipment and all assets are always recorded at their historical cost, and we see here that the equipment was purchased for $75,000. So that tells us the equipment account has a $75,000 balance. So the next account I want to talk about is accumulated depreciation. And this account keeps track of the total depreciation recorded on our equipment. And if we read here, we see that the equipment is estimated to last 10 years with no salvage value and is being depreciated using the straight line method. Now you might remember that to find the straight line depreciation per year, you take the cost minus the salvage value and divide by the useful life. So let's do that here. We'll take the cost of $75,000 minus the salvage value, which is 0 since there's no salvage value, and then divide that by the useful life, which in this case is 10 years. So that tells us that the depreciation per year is $7,500. But if we look at the dates here, we see that we purchased it on January 1st, 2009, and we're going to be disposing of it on December 31st, 2015. So you can count how many years that would be recorded of depreciation expense, and you'll find that that's 7 years. So we can multiply that amount by 7 to get a total depreciation expense of $52,500 as of the date of disposal. Now you might remember whenever we record depreciation expense, accumulated depreciation gets credited. So this is going to be a credit balance for our accumulated depreciation. Alright, now we can move on to part A, which says that the equipment was discarded. So if the equipment was discarded, we have to get rid of the balance in the equipment account and the associated accumulated depreciation. First, let's think about the accumulated depreciation. This has a $52,500 credit balance, so in order to get rid of that balance, we'll have to debit it for $52,500. So let's do that. And then next, I usually leave a space between my debits and my credits in any of these problems, just because I don't know if I'm going to have a gain or a loss until I've filled in the other accounts. So let's leave one space, and then let's close out the equipment account. And we know that has a $75,000 debit balance, so that's going to be a credit of $75,000 to close the account out. Alright, now we can see that our credits are larger than our debits, therefore we have to make up the difference on the debit side. So if we take the $75,000 and subtract the $52,500, we find that our debit is going to be for $22,500. And if you have to make up that difference on the debit side, that tells you that this is going to be a loss. So this is loss on disposal of equipment. Next, part B says that the equipment was sold for $30,000 cash. So that means we're going to be getting cash, so maybe that's the first easy one to put in here. That's going to be a debit to cash for $30,000. And we're still going to have some of the other accounts that we used last time, such as the accumulated depreciation, so we can put that in. We're still getting rid of that balance of $52,500, so we can debit that one. And now I'm going to leave a space for the either gain or loss, which I'm not sure which one it is yet, so I'm just going to leave that blank. I'm going to put in the equipment, still at $75,000. Just to close that amount out. And then we need to determine which is larger, the credits or the debits. And it looks pretty clear that the debits are larger than the credits if you were to add these two numbers up. So therefore, we're going to have to make up the difference on the credit side. So therefore, this is going to be a gain on sale of equipment. And that's just whatever number plugs to make this balance. So what we can do is we can take the two numbers on the debit side, add those up, and then we can subtract the number on the credit side. And that tells us the gain on the sale of equipment is $7,500. Next, we can move on to C, which says that the equipment was sold for $20,000 cash. Now this is the same situation as B, except for now the cash amount has changed. So I'm going to grab our account titles that we used before, and then we'll just edit them as we need to. So the only one that's really going to change is possibly this gain on the sale of equipment, because that's our plug number. It could change to a loss. So I'm just going to delete that for now, and we can fill in the other amounts. The cash is a debit for $20,000 because that's how much we got. The accumulated depreciation is still a debit for $52,500. That's just to close out the account. And same idea with the equipment, closing out the $75,000 balance will be a $75,000 credit. Now if we were to add up our debits, we would see that these two numbers add up to $72,500, which is smaller than our $75,000 credit. So therefore, the difference between those two numbers has to go on the debit side. So we can take $75,000 and subtract the two debits, and we see that that comes to $2,500. And since the difference is on the debit side, we call this a loss on sale of equipment. So if we move on to part D, we see that the equipment was traded in for a newer piece of equipment, and the newer equipment had a cash price of $100,000. A trade-in allowance of $24,000 was granted on the old equipment, with the difference paid in cash. The transaction had commercial substance. So all they mean here with the commercial substance is that the new piece of equipment is going to materially affect the cash flows of the company, meaning that they're not just trading one piece of equipment for another piece of equipment of equal value. The new piece of equipment is actually much better than the old equipment. So if they were to trade in the equipment for a similar piece of equipment that really wasn't going to change the business much, then we would say that the transaction lacked commercial substance. But the journal entries related to those transactions are beyond the scope of this class. Alright, so in this transaction, we're going to have to differentiate between the new equipment and the old equipment, since we are exchanging equipment. So first, let's deal with the new equipment. So we can title that Equipment New. And they told us that that had a cash price of $100,000. So we'll put down $100,000 here. Next, we can think about the accumulated depreciation, which is the same in all of these transactions. So I'm just going to copy that down. I'm going to leave a space for the possible gain or loss. Then I'm going to record the equipment, just like we have in all of the other transactions. But I have to differentiate now that we have two pieces of equipment, that this is the old equipment that I'm getting rid of. That had a historical cost of $75,000. And then if we read closely here, we see that a trade-in allowance of $24,000 was granted for the old equipment with the difference paid in cash. So that means we're paying out some cash here. Now this equipment cost $100,000, but you can kind of think of this as getting a $24,000 discount since we're giving this company, or whoever's giving us this new piece of equipment, some of our old equipment. So the way we find the cash is we take the price of the new equipment of $100,000 and we subtract the trade-in allowance of $24,000 to get a credit to cash of $76,000. Now if we add up our total debits, we see that they add up to $152,500, and the total of the credits add up to $151,000. So that means we have to make up the difference on the credit side, since the credits are smaller. And the difference is $1,500 if we subtract those two numbers. And the title we use for this account is the gain on exchange of equipment. Finally, we can move on to part E, which says that the equipment was traded in for a newer piece of equipment. The newer equipment had a cash price of $100,000. A trade-in allowance of $20,000 was granted for the old equipment, and the difference paid in cash. The transaction once again had commercial substance. So this is really the same problem as part D, except for the trade-in allowance has changed from 24,000 to 20,000. So I'm just going to copy over the same account titles, and I'm going to get rid of the gain on the exchange of equipment because that might change to a loss, and we'll figure that out in just a moment. So let's copy down some of the numbers that we know won't change, including the equipment and the accumulated depreciation. The new equipment is still worth $100,000, and that accumulated depreciation is always $52,500 since we're always selling on the same date. The old equipment also has that balance of $75,000 to get rid of. Now the cash amount is going to change slightly. Now since the trade-in allowance is only for $20,000, we can take the $100,000 price and subtract the $20,000 allowance to get $80,000 in cash paid. Now if we add up our debits, we see they add up to $152,500, and our credits add up to $155,000. And that means our credits are a little bit larger than our debits, so we're going to have to make up the difference on the debit side, meaning this is going to be a loss on exchange of equipment. Again, always remembering, if we have to make up the difference on the debit side, it's a loss. If it was on the credit side, it would be a gain. And the amount of the difference, if we subtract those two numbers, is $2,500. Okay, now we are finished with the journal entries. There's just one more thing I want to discuss, and that's about finding the gain or the loss in any of these transactions. The way I've been calculating the gain or loss is by filling in all of the debits, then filling in all the credits with a space between them, and then whichever side needs to balance is where I put the difference on. If it's on the debit side, that'll be a loss. If it was on the credit side, then that would be a gain. So there's another way you can calculate the gain or the loss, and that is by comparing what the company is receiving, or the inflows from the transaction, to what the company is giving away, or the outflows of the transaction. So just as an example, let's look at transaction E here. In this transaction, the only thing the company was getting was the new equipment, which was valued at $100,000. So the total inflow is $100,000. The company was giving up old equipment, which had a book value of $22,500. And the way you can calculate that is you can take the historical cost of $75,000 and subtract the accumulated depreciation of $52,500. The company was also giving up $80,000 in cash. So the total inflows were equal to $100,000, and the total outflows were equal to $22,500 plus $80,000, which is equal to $102,500. So if we take the inflows and subtract the outflows, we have $100,000 minus $102,500, which gives us a negative $2,500 balance, which turns out to be our loss, which we found earlier. So if the inflows minus the outflows were equal to a positive number, then the company would have a gain. You can calculate the gains and losses either way, but this method can help you understand a bit more why the amount is classified as a gain or a loss.